All right, guys, what's the vibes? Hinkame here, 12:22 a.m. Wednesday. How are you guys doing? All right, so there's something I want to talk about today, and it's a question I got asked by a CEO, and he said, May, if I was just going to trade New York session because this is when I have time to be trading, I can't trade London session, the Asia session. If I was just going to be trading the New York session, what is a straightforward approach that I can use to apply true price that is consistent or that can get me consistent results? And I didn't think too much about it because it's something that I've worked on over and over again. And I decided to share it here because I know, some people might have the same constraints, right? You can only trade New York session, or you are dealing with over trading, and this is the only session that you want to be trading, as it's one of the high probability sessions, right? New York session is kind of like, especially when you trade, fast markets like the precious metals, gold, silver, NAS, right? This session, right, from 9:30 a.m. or even 1:30 p.m. our time here, or 9:30 EST, that time kind of brings the true move of the day. What is that simple thing I can look for? And it's very simple, right? We'll get into it and we'll look at some examples, right? One of the most fundamental things about price is liquidity runs. If you can understand liquidity runs, you can understand short-term, long-term movements of price, right? If you can start to pair your trading alongside liquidity, you get it, right? And we're going to look at the three-step process, how we look at liquidity, and to just give a little bit insight on liquidity points, to not just make it complicated. A toddler would understand this. Every high or low that you see in the market, every swing high, swing low that you see in the market, or obvious highs and lows that you see in the market, liquidity points, or that's it, that's a liquidity point. So the highs are called buy side liquidity, the lows are called sell side liquidity. The thing to understand is money is resting below and above these liquidity levels, right? And if price is going to go lower, right, it needs a pair of buy side liquidity. We need to run out buy side liquidity to go lower. The way I like to say it is buy side liquidity is food for sell side delivery. So it's like if buy side liquidity is not taken, there's no strength for price to move into sell side. If sell side liquidity is not taken, right, there's no strength for price to move into buy side. So in my criteria of trading, which is what we're going to deal with, right, for me to take a trade, buy side or sell side liquidity is the first thing to happen. That's the first criteria, right? This is going to be a simple checklist that's going to transform how you think about your entries, right? So the first thing is run on buy side, sell side liquidity. That's the first thing that we want to think about, right? But remember that we are trying to solve this problem for the CEO, right? That just wants to trade New York session. All right. So run on buy side, sell side liquidity is what we're looking for. We don't have any business with Asia session. We don't have any business with London session, but there's something we need to mark out. We need to have London session marked out when we come around 8:30. So the moment we come at 8 o'clock, right, 1 p.m. our time in Nigeria here, right, what we want to look for is we want to mark out 2 a.m. to 5 a.m. I have it marked out by an indicator here. That indicator is ICTQ zones. Go to indicators up here and type in ICTQ zones, right? This one, right? The moment you see it, just double click it. It's going to show up here and just put it on, right? When you put it on, you're going to see, all of this. You're going to see all of the sessions that ICT has talked about being spread out. In here, it says Asia, London, New York launch that we call London close, right? So you see all of that. But a as a New York trader or somebody that just wants to trade the New York session, what you want to look for is you want to mark out the highs. In this case, it's already marked out, but I will just mark it out again, the highs and lows of that session. It's a straightforward thing, and you can do this on 5 minutes or 15 minutes. I'll advise 15 minutes if you're looking broader, right? And if you can handle the smaller time frames, just do 5 minutes, right? So those two time frames are the time frames that we're going to be using here. Now, look at this. The thing you just want to mark out is this. Now, the concept of liquidity is that price would aim for liquidity above and below. So it would aim for buy side liquidity and then aim for sell side liquidity. A good analogy for this is you work in an office, right? We do not, but let's use that analogy. You work in an office and you were told by the HR that you have a check to pick at the CEO's office, and then you also have a check to pick at the senior manager's office, right? So this is money that is waiting for you at both offices, right? And to just put it in context, the CEO's office is 2 blocks away from you, and the senior manager's office is upstairs. What are you going to do first? You're going to go to the CEO's office first and pick the check, right? That's from the CEO's office. Then what are you going to do next? Then you're going to go upstairs and pick the check from the senior manager's office. You're not going to leave one for one, right? But you have to go to one before you go to the other. That's the concept of liquidity. Price would aim for where money is resting. Wherever it goes first is where it's closer to. Wherever it goes first is the one that is closer to it. And that is dependent by other factors, but we don't need to care. Our idea is that we can identify where the money is resting. And the money is resting above sessions. Asia's high, Asia's low. London's high, London's low. New York high, New York low. So if we're going to be trading New York session, what are we looking for? We're looking for London's high, London's low. What we want to do, this is not, you don't need a long-term bias. Remember, this guy is a CEO. He doesn't really have time. Yes, in the weekend, he's going to do his analysis, but he wants to get into a trade. He's not looking to catch, 6,000 pips. He just wants to get a trade for the day. He's a day trader and just wants to keep staying smooth. He's not rushing his money. He already has money, just trying to get more money for himself. Or this guy is a student and is just trying to, get in a little bit of trades to just support his business. And many times we overcomplicate trading and forget that the easier we can make it, the better for us. Because then you can work on that and just multiply it. Right. So we mark out London's high and London's low. This is the CEO's office. This is the manager's office. Simple, right? Power of three. The same way each candles form in price. Price runs out what? Buy side liquidity first, right? That's London's high first. We already have what is called trade ideation. So I said the first thing that we're looking at here, where's my, okay, is run on buy side or sell side liquidity. In this case, price has run out buy side liquidity, which is London's high. Now, the moment price runs out buy side liquidity, we're going to do the next best thing, which is we're going to wait for a break in market structure. Now, I'm giving you my own, this is my strategy for entering trades. These three things must be part of my trade checklist. If it's not, then it's not a good trade, right? So the next thing is breaking market structure. Break in market structure. The reason why this is important is it allows you see the willingness of price to go in the direction that you are ideating. So because price has taken out this London's high, your ideation goes to London's low is next on board, right? That's exactly what your ideation is going to that. Okay, we're then going to move to London's low. So you are bearish in the sense. But what then gives you a confirmation that we are actually bearish? It is willingness in the direction, which is breaking market structure, right? And it's denoted by consecutive candles closing below an old low. In this case, we don't quite close below this old low. If we go to 5 minutes, we'll see one. So this could have been first entry, right? We already see price run lower. Now, there are two ways to get into the execution here. One of them is the moment it takes out London's high, right? We look to the left side and find a known PDR array that we understand. That could be fair value gaps as we see inside of here, or maybe an order block, or a fair value gap, or a breaker, whichever. But this is mine. I'm talking about mine. I'm just showing you the other things that you can do. Some of you already have, levels on the left side of this chart that would get you right into what you want to see. Sometimes I do that too, but this is what I would acknowledge as my A+ setup, that after we take out that buy side liquidity I'm looking for, I want to see a breaking market structure. Remember that we want to be doing this in New York session. This is when this guy has time. He only has time to come in from around 9 a.m. to around 11 to watch price and get an entry. So 9 a.m. is here, right? He has seen the run on buy side liquidity. He would be waiting for the breaking market structure. That's the time he has to trade, right? There needs to be a time you have to trade. You're not just going to jump in and see a trade. There needs to be you waiting through what you want to see play out. Is what we do in the inner circle from 2 p.m. till around sometimes 4 5 p.m. Right. We sit down Tuesday, Wednesday, Thursdays, and we're looking at price together, figuring out setups. Right. Look at this. Price breaks lower, and then we want to see the last thing. Like I said, it's a very, very simple three-step process. Run on buy side liquidity, which we are looking at as London's high, breaking market structure, which we have seen here, and then a return back into the premium of the range. I'll explain that. Return back into premium or discount of the range. Now you ask me what range? Every time we have a breaking market structure, a range is formed. Every time we have a breaking market structure, a range is formed. That means that consecutive candle here, the high of the consecutive candles to the low of that consecutive candles is a range. If you use your fib and you pull it out and say high to low, what are you looking for? You're looking for price to return back into anywhere above the 50% of the range. Now, this can be your trade setup, right? Now, for me, I would look for a bearish order block, which we have here as the entry, and the high of that range is going to be where my stop loss is. Some people would say, oh, you know what, I'm just going to put it at the moment it gets to the 0.5, but your entry needs to cover the high of that range because that's what tells you or supports your bearish direction. Why is that? It is that because if you are calling this a breaking market structure, it means you are bearish. In a bearish market structure, old highs stay. Old highs do not get taken out. So that's why your stops are here. If price takes you out, then you are wrong. As we go on, we would see examples. Maybe we would get there where price disrespects what we want to see, and that's okay. The ability for you to say, you know what, one trade doesn't define my output or my outcomes of being profitable is when you just started being a trader, where you can accept losses because it's part of the business. You'd have everything right and still get a loss. So you need to be able to sit with it. Remember, London's high is run, so we're looking for what? London's low. So my CEO already has a trade now for today. Today he already has a trade. He's going to take that trade and run lower. Now, some people might say, May, I really do not like this, especially on the 15 minutes. This is not truly a breaking market structure because we don't see a close below this low. Well, there is a breaking market structure that happens. So let's say he missed this entry, right? And it looks further. What happens? Price breaks market structure here, right? This is a clear close. Again, consecutive candles that close. The same thing we are doing, right? High. Remember, every time there's a breaking market structure, there's a new range. Some of my smart guys are looking at this and say, oh, that would just be entry two. Exactly. That's how you start to pyramid. That's how you start to learn. The ability to start to think about your trade ideas as not just one-off ideas, but also ideas where if they play out well, you can actually maximize what would have been 1 to 3 R to 1 to 6 R. Right, that's what pyramiding is. And if you're going to really, do well with your funded accounts, and especially in evaluation stage, you need to be able to make one good idea pay for multiple stress of trades. So if you entered in here, you can join in here, but let me not diverse. I digress. So look at this breaking market structure. He did not see this one because he did not consider it. He's trying to just stay on the 15 minutes time frame. He doesn't want to go, lower than 15 minutes time frame. Right. Some of you are like that already. So I'm just having you in mind. Right. So what is here? We have a mitigation block, the down close candle before the run higher, and then the break. That down close candle before the run higher, right, is a mitigation block, right? Failure swing is this high, and then we break market structure. The low before that run to cause the failure swing is your mitigation block. That's an entry, but I just use the 50% mark so that you make it easier. OT high, low, OT 50%, and it's aiming for this lows. So what have we seen? We've seen that for today, my CEO has gotten a trade that would offer in this particular trade idea 1 to 2, and for this one, right, it would be 1 to 3.7. Good for the day, right? Let's go and look at more trades. That's all I want to show you guys. That is crazy, but that's really just it, right? So let's look at this, right? It takes out, it comes in New York session 9:45, right, or 9 a.m. And what has he seen? He has seen a run below London's low. Now, keep in mind that this guy comes in at 9 a.m. And that's what I want you guys to think. If you can make it as compact as that, you take away all of the complexity. That's what this video is to do, to make it easy for you to get into your trades, right? It has taken out sell side liquidity. And what is he doing? He's waiting for a breaking market structure. Price rallies here, 8:30. Okay, let's say it comes in about 9. What is 9 o'clock? 9 o'clock is here. Try to say a rally, but does it break market structure? But now it breaks market structure. I want you guys to watch this. So my guy's very systematic. He's not doing any of those complex stuff, right? So he's waiting for price to come back into premium. Price doesn't do that, right? Price doesn't come back into discount here. He's waiting for price to come back into discount because this is Asia's high where his target is. Did I say Asia's high? I'm mixing it up, right? London's high where his target is. This is where he wants to exit his trade, or this is where he wants to start to, take profits if he bought down here. But look at this, price doesn't get here. So in his case, he can say, you know what, this was my entry, right? The discount part of that range, my stop loss would have been here. I would have been looking at, this level, right? Or maybe it was aiming for this order block, which is what I would do. In my case, I like to look for discounts when after it's breaking market structure. So we had run-ons, London's low, that's the run-on liquidity. We had breaking market structure, but look at this, price did not come down into discount. So you see, in this case, he would have missed the trade. But look at what happens. I would show you how this progresses. After that happens, right, just looking through the tape, right, we have something that happens, right? Price comes inside of a fair value gap, right here, and then expands. This makes this order block very important. And I'm going to give you another source that I did not plan for this video. The moment we have a fair value gap, deliver a break in market structure, or deliver institutional sponsorship, it is a valid order block here. When you see an OB and price form gets into that OB and then forms an order block, right? What I want you to look at is when price got into that OB, what we saw was just bullish candles. This is showing strength in the trend. This is showing institutional sponsorship. The OB you find from that fair value gap, I like to say it like this: an OB from a valid fair value gap is a valid order block. What that means is it is a valid fair value gap because what we can see an expansion ensue from it. So we can see an expansion come from that fair value gap. It makes that fair value gap a valid fair value gap. Anything that causes an expansion is valid in the market. Why? That's what you're looking for. When you get into the trade, what are you looking for? Speed. Nobody wants to see a consolidation, even though it happens. So whatever is valid is whatever causes expansions. So when we see any of our PDRA cause an expansion, it's important. That's another source there, guys. But let's go on, right? So we see the expansion, and this would have been a trade, right? Yes, we already saw um London's high taking. So, this is just, being extra, especially for you guys that have been in the markets for long and probably were thinking about buy side for the day, right? We see price expand, beyond Asia's high. And depending on what stop levels you're thinking about, that would have been a good trade, right? If you're just waiting for this high to just get taken, the previous day's high, which is a drawn liquidity, right? That would be a 1 to 2.6. It has a trade for today again, right? What are we thinking about? We are looking for runs above London's high, right? And then we're selling. We're looking for run below London's low, and then we're buying. I have all of these things here, and I'll just pitch them out. I just thought about the question again, and I'm like, this is going to really be good for somebody that is just, having difficulty with having one thing that they can just stick to and watch how it works over time. All right, so this is Friday, and we have a run above buy side liquidity. This was NFP, so probably, he's not trading there, but let's still see, like, forgetting, whatever has happened here, let's just see if the model is something that can just work throughout whatever we just put on it, right? Not thinking about NFP, not like we're not trying to complicate everything. After we had our run, New York session starts here 9:30, right? What happens from 9:30 breaking market structure? That means we have high to low as a range. We have a return here, and we can sell. We can sell this move from this OB right here, and then we have a stop loss here. I will take out this other ones, right? And maybe we are expecting London slow, right? So that would have been a trade for a 1 to 5. What I want you to see here is this trade delivered a 1 to this trade delivered a 1 to 3. So with a system that we could build, right? When you get into the inner circle, one of the things that you get is a system that you need to follow for the goal that you're at, right? Coming into the inner circle is not for everyone, right? And we're not harsh to say that. It's just that it's a space where you're trying to scale your trading, not learn your trading. What does that mean? You're trying to get funded, you're trying to scale your live account, right? And as you come in, you get a goal that you're working on, right? Based on the level that you are, right? And if it's a funded account, you can't just have your trades at random. All of your trades needs to be planned, right? Because you can be playing with a 0.5, right? And we did this study, right? You can be playing with a 0.5, risking or, looking for a 1 to 2, and you never pass the account, even though you have 8/12 trades, even though you have 8 wins out of 12 with a 0.5 and you have 8 wins out of 12, you're going to have 6% profit at the end of the month. You are not going to pass the account. And that's where frustration comes to some traders and they're not able to expand on this. If you guys want me to talk more about this, I'm going to share you an eight book playbook. I can send it to you. Just comment under this video playbook. I would send you the framework, the eight book, the eight playbooks for a prop firm, and you will just clearly see that if this is how you have been trading, you sleep on an account and you see other ways. That same thing that I just told you, if you change the the um the framework to 1 to 3 trades instead, and that's what you are aiming for, and you use a 0.5, you're going to pass phase 1 and phase 2 in 1 month. The same framework, but all you just shifted was the risk to reward. So when it comes to prop firm trading, like you have to have a plan set. If you're going to take losses, you're going to take losses. If you're going to have wins, you're going to have wins. So let's say my guy is following my protocol and is using a 1 to 3 or a 1 to 2, just depending. You have this trade in and he's done for the day, even though it's not a day that is high probability because it's just after an NFP. So I hope you guys are seeing, this. Let's go to the Thursday before that day. All of these are just my backtesting notes. I would clear them up and then we would look for what's London's low is, because the Q zone thing expires after a couple of days. So we'll have to manually look for London's low. But I think it's clear here. This is 9 a.m. So London's low will be somewhere here. 2 a.m. I'll bring this down to just solve that. 2 a.m. starts here. Where's 5 a.m.? Okay, 5 a.m. stops here. So this is London's low. This is going to be our last example. Like all of my videos, if you are going to really learn how to trade, you have to put in the work. The work that you need to do is take whatever I've shown you here, put on the skeptic cap, take that trade, take that pair that you trade and run it over the last 3 months, run it over the last 6 months, run it until we are confirmed in your spirit that this works. London's low, right? And this would be London's high here. Just the same thing, London's high. Now, London's high. So if we have this, right, London's low, we're looking for a run above one of those levels. We don't care which one is going to happen first. We just want to see which one then happens first, right? So going into 8:45, my guy is not yet on seat, but 9 o'clock here is on seat. And from 9 o'clock, we want to watch, is there a breaking market structure? And actually, we see that price actually closes above this high, not with so much of a breaking market structure, but the close kind of comes in here. It's not so smooth. All right. So let's say it buys here, just giving it a chance that, it looks like, even though it's not it, it buys here. What's going to happen is going to take a loss. It's going to take a loss. And I have to show you this because there's going to be times where you're going to have everything set up and it doesn't work out, or you're just going to feel like it's there and it doesn't work. Now you see that this loss doesn't mean that the directional bias was bad. But one of the things that we cannot do as traders is we cannot determine how much of manipulation is going to happen, how much of accumulation, how much of sell side liquidity is needed for buy side to ensue. I said sell side liquidity is food for buy side. But what I did not say is one, sell side liquidity is enough for buy side movements, or two is enough. That's why we have something like three Indian patterns. That's for my, the guys that are getting advanced. But we're not trying to make this complicated. If we look at that and we see this run, all we need to wait for, if we still trust this idea, is a break. That break happens in Asia. But remember, my guy is going to be sleeping. Somebody like me, I'm going to be active here, and then I'll buy this, right? Same idea, breaking market structure, we're waiting for price. This is every time we have breaking market structure, it's a range. I was buying this particularly, right? And I was able to see all of this in terms of return, right? And in this way, you actually can just expand how you see price, right? You can just reduce the barrier of complexity, right? The degree of difficulty to zero just by doing this, right? And you know exactly what you're looking for every single day when you look at price, and very quickly you're able to see progress, right? Some of my smart guys here are already thinking about this and they're like, oh yeah, that means I can do it on New York's high, New York's low. I can do it on Asia's high, Asia's low. I can do it on previous days low to previous days high. Exactly. That's the thought. And you can maximize this. You can morph it into something more interesting. Guys, if you need its book playbook, or the its play the its playbook for risk management, right? How you understand, if what you are using as risk is actually going to get you profitable, and it's really spelled out. I wish I can show you here. Let me see. Let's see if we can have 1 minute. Our time is fast spent, but let me see if I can have 1 minute to show you that here. Okay, I think I know where to show you. Let's just go into Discord. That would be really faster. So I also dropped the link to the Discord channel if you want to be part of the Discord, right? This is the team chat where everyone is, and this is the inner circle where, the real things happen. All right, let's look at this. All right, so this is what I'm talking about. I'm going to share you this playbook, right? And just to show you what I talked about earlier, if you were risking, if you were risking 0.5, if you were risking 0.5, right, and you had 2 wins, 1 loss every week for 4 weeks, you end up with plus 6%. If you have 50% of your trades win, which many traders fall in, like if you take 10 trades and you have 5 win, you will only be positive plus 2%. That means this risk pattern cannot work for your trade, for your evaluation stage, because you sleep on it. Do you understand? Right? And there are ones that can work for it, right? We will not be able to go through it. There are 8 of them here that can actually, give you a good risk to reward. Look at this. If you are using a 0.5 still, but with the 1, 2, 3 RR, you have 16%. You will get funded in 1 month with a payout. If you have 3 weeks, 3 wins, 1 loss, just meaning that if you have, out of out of 16 of your trades, if you have 12 of those trades, you're on a streak and you have 12 of those trades win, you actually have a month where you have a payout gotten and you pass evaluation stage in 1 month. And these are the things that we build here. These are the systems that we have here. All right, guys. So if you want more for this, just comment playbook in the comment section and I'm going to meet you there with all of this. I'll send it to you and you can just use it for free. All right, guys, I'll see you in the next video. Let me know if you got value from this. Peace out.